Right, good afternoon, everybody. Thank you for joining. We've got people continuing to join, but I'm going to crack on because we've got plenty to get through today. I'm Alice Gill, the Exec Director here at the Chamber of Commerce, and we've put this session on because we understand that there is a lot to be understanding at the moment in terms of what is going on with the discussion around tax reform. So government are currently consulting on corporation tax, and the deadline for putting in your submission to the consultation is the end of this week. So if you haven't done so yet, I would encourage you to do. We did do a webinar on the detail of the corporate tax consultation last week or the week after. Oh, firstly, can I ask everyone to put themselves onto mute? And I will share the link to the corporation tax webinar if you didn't watch it, because it will be helpful for you filling in your corporation tax response. But this webinar today is solely on the GST-plus package and everything that goes with that. We've got some people from the civil service here to step us through that, and I'll get them to introduce themselves in a second. And I've also got Diane Degari, who's a board member for the Chamber of Commerce. Just in terms of how we're going to run through this, will be a presentation on all the details and everything that you need to know around GST, and then we'll do quite a lengthy Q&A at the end. If you can submit your questions into either the chat or the Q&A box, I'll go through those and pose those to people at the end. Anything else that I have forgotten to cover? Anyone else? Oh, and to mention that this is being recorded, just for your information. So I will hand over to Rob and the team.
Okay, thanks, Alice. So my name is Rob Moore. I'm the state's Senior Relationship Manager.
I am Liz Lenné. I am the Senior Economist. I'm Nikki Forsher. I'm the Director of Tax Policy.
I'm going to take you through a little presentation, first of all, on the tax reform work stream, which is sometimes known as the GST-plus work stream. And the idea today is to take you through, first of all, give you a bit of an overview of what this work stream is doing. It's looking at how you go about implementing a GST-plus package, but it's doing that in the middle of a political process where decision making is still taking place as to what the future tax reform will look like. So we'll do a bit of an overview of how those two work streams are happening in parallel and why that is being progressed in the way that it is. And then we'll look at the elements of the package, and we'll go into a little bit of detail. So we'll look at GST itself in a little bit of detail, but this is a package that has a number of different kind of key pillars. So we'll go through each of those, because some of them get a little bit more attention than others, and some of them might have passed under the radar a little bit for businesses, but we think actually they're probably some key points that businesses should be aware of, just in terms of understanding how the package would work if it were a package that the states decided to proceed with. And I'll kind of explain what I mean by that now. So I'm just going to share my screen and get a little presentation set up for you all. So you hopefully can see me. So I'll switch on my screen a little bit. Can you see me, Alison? Can you see the presentation too?
That's perfect.
Okay. Right, okay. So where are we in this political process is probably the best place to start. And maybe I'll just do a very, very quick history. I'm conscious of time. We want to make sure we got time for questions at the end of all this, but I'll just do a very quick history to kind of set the scene a little bit. You will probably all remember that in the previous political term, there were a number of debates on tax reform. So the Policy and Resources Committee at the beginning of the last term, so that was the Policy and Resources Committee led by Deputy Fairbrush, brought forward, I think probably in a total of say 3 occasions. There was a green paper version. If you include that, I think we had 3 debates looking at a package that has come to be known as the GST-plus package. And that package was unsuccessful in the states each time that Policy and Resources Committee took it to a vote. But then towards the end of that term, the states decided to remove that Policy and Resources Committee and appoint a new Policy and Resources Committee led by Deputy Trott, who were in that role for probably the last year or so of the political term, running up to the election. Within that time period, they had the last budget of that term to deal with, and in the process of, so they proposed in the budget, and they considered this kind of tax reform question because obviously the previous reform package had been rejected. They looked at what do we need to do, keeping in mind the fact we've got an election coming up, and we still have this uncertainty on how we're going to resolve the future sustainability of public finances. And their proposal was to increase income tax by 2%, almost on a kind of time-limited basis that would allow them the next assembly to look at the tax reform question in more detail. The politics being politics, the states members, some of those who were still supporters of that GST-plus package, put it back on the table by way of an amendment and kind of said, if we're going to look at this income tax proposal, we should have it alongside this GST-plus package and let the states consider it in that context. On that occasion, so unexpectedly, I think, for those who probably had assumed that the previous P&I's attempts to get the GST-plus through were unsuccessful, in a kind of a late move sees GST-plus back on the table, and on that occasion, the states supported it. And so that political term finishes with GST-plus as the tax reform package that the states has decided it wants to progress with. But obviously election then comes along, and a new Policy and Resources Committee, new states members in a new P&R committee take up their roles. And the new P&R committee looks at the kind of situation in front of them and says, and taking on board all of the feedback that came during the electoral process, we need to look at tax options again. We need to do a further review. We need to do that as quickly as possible, though, because obviously every time this is debated, if there isn't a clear decision, time is ticking on, and that question of the sustainability of public finances is still outstanding. So we're going to do a really quick review, aiming to come back with recommendations to the states by Q2 of this year at the latest. So we're looking at probably June this year. But it also said, well, what if at that point the states decides it does want to continue with the GST-plus package? We may have lost quite a chunk of time in doing that review, even if we do it quickly. So the P&R committee made the decision that the work stream on how you would implement GST-plus should continue alongside a further review of tax options. So that's what this slide on the screen is trying to illustrate. It's the two work streams happening in parallel, and the green pathway at the bottom is the review of other tax options, and it's focusing on corporate tax options. And Liz and Nikki gave a webinar, Chamber of Commerce webinar on that a couple of weeks ago, which Alice mentioned before, and there's a link, you can watch that back if you weren't able to watch it at the time. And then the blue work stream at the top is the one that we're going to focus on today, which is just looking at the question of if the states decided it did want to proceed with GST+, then how would that work? Some of the timings in here come as a result of working backwards from if you were to proceed, if the states were to proceed with the GST+, if that's what it decided it wanted to do, and it wanted to then try and get that in place by what at the moment is the kind of the date we're aiming for in 2028. If this all goes ahead, implement in 2028, then to work backwards from that, one of the things that we're considering as part of our engagement with industry is how much time does there need to be for businesses from the point at which a decision is made, a final decision is made, and there's some certainty on what tax reform option is going to go forward. From that point to actually implementing, how much time do you need? We're saying 18 months really is what you would want to have, and maybe you could do it at 12 at a push, but ideally we go for 18, and that means a June decision this year that gives you that final decision, gives you that 18 months before the beginning of 2028. So that's kind of why June is a key date, and you'll see that on the slide there, that Q2 debate where the two hands are shaking. But you will have all followed the media, and you will be aware that there is also obviously a GST related states debate taking place this week. So why is that happening? Well, one of the decisions that was made by the previous states when it said, yes, we want to go ahead with GST+, it added a little caveat to that said, we do also think there should still be a further decision on whether that GST is applied to food in a retail or kind of supermarket setting. So there was still a question mark as to whether this would be, if it were to proceed at all, would it be a package that included food in the standard rate, or would food be zero rated? And that obviously changes the nature of the package and gives quite a few things to consider in terms of operationally, how would you implement it? And in order to not eat into that 18-month timeline after a June decision is made, that food decision kind of needs to happen first. So P&R has ultimately brought a paper to the States now that says it has a few elements in it, but probably the chunkiest one is, do we include GST on food or not? There's a few other bits and pieces which we can talk about, which help to kind of inform what the design of the GST plus package is before a final decision is made on it. That's all happening in this week's States debate. But obviously, again, as we saw at the end of last term, amendments can obviously change the nature of the debate. And there's a few quite key amendments that have been brought to this debate, including whether or not to stop work on the GST plus package. So all of that is, that's the kind of political landscape, I suppose, at the moment. But for the purposes of today, we're going to try and step away from that a little bit, because ultimately the task of this work stream, and the task then for us as officers in this context, is just to look at, if the States does ultimately decide to progress this, we crack on with how would we go about implementing it. And so a lot of the work that we've been doing over the last few months is really about engaging with industry sector by sector and trying to find out more detail about the various business practices that different sectors do, so that we know all the things that need to be considered in building what the GST plus package would look like in detail. So the kind of what the states previously agreed gives you all the kind of key pillars and the high level stuff, but there's lots of detail within that needs to be looked at and ironed out, that if the states then decided they wanted to do it, we'd be ready to implement in a smooth and seamless kind of way that ensures that businesses are supported and get all the right kind of communication and guidance that they need to be able to do this. So that's setting the scene, hopefully, and gives a bit of context of where we are. So now we'll jump into what's in the package, and we'll start taking those pieces one by one. So at a kind of top level, the package has these main elements. So there would be a new headline income tax rate of 15%, and I'll go into a bit more detail on that in a moment. There'd be a restructuring of Social Security contributions. That's quite significant. That probably gets maybe the least coverage, or gets talked about the least out of all the elements in this package, but actually it's quite significant and is really worth businesses understanding. So we'll go into more detail on that. There's the GST itself, and we'll absolutely talk about what that would look like, how it works, how you would file returns, all that kind of stuff. And there will be an increase in pensions and benefits to account for the inflationary impact of the GST, and we'll talk about that in a little bit more detail too. This is a slide you probably have seen, this slide or a similar version to it before in previous kind of comms around the GST plus package. This is essentially the modeling of what does the package as a whole, when put together, the impact on households of different levels of income. What does that look like? And it's done by percentile. So it's looking at, each column is a group of 5%. If you were in the bottom 5% of households in terms of income, or the next 5%, or the next 5%, what would the impact on average be for the households that are in those particular groups? And so broadly, the package, is intended that households on lower incomes are better off, and households on higher incomes pay more. And the little kind of markers there that show, 2 adults, no children, 40K, for example, that's just an indicator of if you're in that kind of 20 to 25% group of households by income, what does that mean in terms of an actual income level? In the case of a household of, 2 adults, no children, in that kind of 25% point, it would be 40K income, but that will vary depending on the makeup of your household. So what are the actual bits of the package? So we start with income tax, which is one of the simpler ones. So obviously at the moment, the income tax rate is 20%, and people have a personal tax allowance of around 15,000. It's 15,200 at the moment. So your earnings up to 15,200, you don't pay any tax on those, and whatever your income is above that, you're paying 20% now. Very simple. What would be proposed as part of this package is that there would be a new headline rate of 15% that goes up to £32,400 roughly. So that means everything from that personal income tax threshold up to that 32,000 is taxed at 15%. Everything below the threshold, the personal income tax threshold is still 0%. Then there's a 15% band, and then above 32K, it's 20% as it is now. And that means that in terms of how that impacts people, obviously, if you're earning somewhere around that personal income tax threshold of 15, 16K, you're already paying no income tax, so that doesn't change significantly as a result of these changes. If you're earning somewhere around the 32,000 mark, then all of the income tax that currently you would be paying at 20% is going to be going down to 15%. And then if you're earning beyond that, then it's a combination. Some of your earnings are 15 and some are 20. So, you know, as we say on the slide, they're probably the group that most benefits from that impact of those that are earning around that £32,000 threshold, who will see all of their income tax or a lot of their income tax reduced by 5%. That's a pretty straightforward element of this package. The next bit is Social Security, which is a bit more complicated. I'm going to hand over to Liz to deal with that bit for us.
Okay. So the progressive reforms of the Social Security contribution system are quite key to the way this plays out, the impact on households in particular. One of the reasons this is included in the building of this package of measures is that very early on in the process, in the last term when we were developing this, we identified that the way our current Social Security contributions system is set up has some really quite significant problems and inequities in it. It has been built over a number of years with changes at various points and additions of bits and pieces of things, which means that the whole thing as it stands at the moment does not really stand up to scrutiny very well. So that means as things stand at the moment, some people are paying contributions on only their employed or self-employed income, and they don't get any kind of allowance attached to that. There are another group of people who don't have employed or self-employed income, who are therefore paying on all their other income. So things like rental income, for example, comes into charge for those people, and they are paying at a much higher rate, but they get an allowance. Then there's a different treatment again for people who are over pension age. So what it means is that there's a real lack of consistency in the current system about how people are charged. And because most people who are of working age are either employed or self-employed, you are paying right from the pound one that you earn, as long as your income is above the threshold. You pay your contributions on the whole of your earned income. So one of the objectives that we were set was to address some of the inequities within the Social Security contribution system. So there would be some changes coming through if this package were to be the way the states decided to ultimately progress. That would be to add an allowance for all employed and self-employed contributors, which means that very much like the income tax system that Rob has just described, you wouldn't pay Social Security contributions on the first £16,000 of your income. You would only pay contributions on your income above that threshold. Now, because that pulls a lot of income out of charge for Social Security contributions, you have to adjust the rates attached to the contribution system to balance that. We're also suggesting that because we've got some people who are being charged on their unearned income and some people who aren't, which means that things like income from rental properties, for example, is charged for some people, but not for others, depending on their personal circumstances, that actually one of the things the policy seeks to do is to align that so everybody is charged on the same basis of income, and that would include kind of unearned income. The combined impact of those changes for individuals is that for low and middle income employed or self-employed people, they would be paying less Social Security contributions, in some cases quite considerably less. There is a slight increase in the rate applied for pensioners, but the change is relatively limited because they're already getting an allowance. They don't see the same kind of shift. For people who are higher earners or who have quite a lot of unearned income in addition to their employment or self-employed income, they may be paying more in contributions. So the net effect of all those changes for individuals is that, generally speaking, at the bottom end of the income profile, we would be expecting people to pay less in social security contributions. At the top end of the income spectrum, we would expect people to be paying a bit more. Then layered on top of that is an increase in the contributions rate applied to employers, and a change so that above the current upper earnings limit, which is somewhere around £190,000, which for individuals, you stop paying any further contributions on your income above that level. What we're suggesting is that for employers and for the earned income self-employed people, there would be an additional reduced rate on income above that threshold of 2.5%, which replicates a feature of Jersey's contribution system. They have something similar in the UK. That means that the contributions liability for employers will be going up. All those changes versus 2024 have an approximate net change in revenue of about 5 million. Most of you will be aware that there has been an underlying process behind the scenes on this to increase contributions from about 2022. So there has already been some additional revenue raised between 2022 and 2024, and that process of increasing the contribution rates will continue in the background, and if this comes into play, it will replace that process at the point that it is introduced. So the next step, the next bit that we're going to talk about is the treatment of pensions and benefits under the concept of GST. So a GST will increase the price that you pay for goods and services in the community. That will mean that there will be an increase in inflation for a period of 12 months after the introduction. Our existing benefits systems have built-in mechanisms within them to adjust to changes in inflation. So from the 1st of January each year, there is an uprating of pensions and benefits for the impact of inflation in the previous year. There are also within our means tested benefits mechanisms which adjust to any change in your income tax and social security liability. However, if the states choose to go ahead with this package of measures, we know that the GST will have an impact on inflation. If we allow the normal processes for the pensions and benefits to take their natural course, potentially people could be waiting 6, 9, 12 months before that inflationary adjustment is made to their benefits. So what the package proposes is that, given that we know and can estimate this impact, we bring forward that inflation-linked uprating of pensions and benefits, so it applies at the same time that the GST is implemented, so people get that compensation to their income through their pensions and benefits upfront. So that means, generally speaking, people on income support should see very little overall net impact from the application of this package. They will see an increase in their costs, but their income will also increase. But we did identify through the process of developing this package that there are a group of people who have potentially quite a low income, but they maybe choose not to claim means tested benefits, or they don't qualify, perhaps because they've got a lump sum pension payout or something like that, which will put them over the savings threshold to be able to claim income support. So one of the mechanisms designed was what is being called an essential cost support scheme. I think it's actually essentials cost relief scheme. Sorry, I got the word wrong on the presentation. And essentially what has been done is we have gone away and looked at the basket of goods and services that is used to establish people's income requirement for income support. So that covers not just food, but an allowance for clothes and carpets and cleaning products and electricity and water, and a whole range of goods and services that is deemed to be necessary to maintain a basic standard of living. And we've gone through that basket and estimated how much we would expect somebody to incur in GST on that basket, and set up this cost support scheme, which I think is on the next page, essentially cost relief scheme, that's right on this one, which essentially offers an annual one-off payment for people below an income threshold who can't or don't choose to claim income support, and essentially provides them with the equivalent of the amount of GST that you would have paid on this essential basket of goods. It's set up so there's a rate for a single person household, there's a rate for a couple. There is a cost attached to that, as you might imagine, but we also don't expect that everybody who looks like on paper they might be entitled to claim for that would come forward. There are undoubtedly some people who would decide that they have the wealth and the capital resources, but they don't need it. But it is there as a net of protection for those people who otherwise we aren't adequately protecting, either through the normal means tested pension systems, or who aren't benefiting full from the changes to the tax and social security systems. The reason there are two different rates attached to that essentials cost relief scheme is because the calculations are quite different if you standard rate food at 5% GST, which is the primary proposal that was agreed in November 2024, or the alternative route, which is one of the two options available to states members this week when they're considering whether or not GST should be applied to food, where you zero rate food in a retail setting, but in order to replace the lost revenue from that, you have to increase the standard rate of the GST up to 6%. So when you kind of stack all those various bits together, including the GST, and Nikki's going to talk about the mechanics of the GST in more detail in a second, you can see that relative to where we are at the moment, there's some small change in the revenue from the social security contribution system, but generally from a 2024-2025 perspective, that's broadly net neutral, but with a redistribution within that from where the money comes from and who's paying it. Reducing the standard rate of income tax to 15%, with 20% becoming the higher rate, has quite significant cost implication. So that reduces our net income tax revenues by around 35 million. The GST is expected to deliver about £82 million worth of additional revenue. Of that, somewhere in the region of 60-65 million is going to come from the consumption of households. Another 6-7 million we expect to come from the consumption of visitors to the island, and then a further 10-12 million is expected to come from something called the International Services Entity Scheme, which I think is further explained a bit more further on in the presentation. Then there is a cost attached to the changes to the benefits and the administrations on an ongoing basis. Shake all that up together, and you get a net change in revenues of somewhere in the region of £50 million. So I'm going to hand over to Nikki.
Okay, thank you, Liz. So I'm just going to take you through some basics of how a GST would operate if that is the direction the state chooses to go at the end of Q2. So GST is an input-output tax. So this means that if you're a registered business, so a GST registered business, you would collect GST from your customers at the point of sale, and then you can also reclaim the GST that you incur on goods purchased for the business, so electricity, water, etc. The difference between the two, so the GST that you collected on sale to your customers and the cost you incur is then remitted to government on a quarterly basis. So the difference between the two. So within the GST proposals, the intention is that there would be a mandatory registration threshold. So if you're a business that made taxable supplies, which for most businesses would be the same as their turnover, of above 300,000 a year, then you would be required to register for GST and submit those returns quarterly. If your taxable supplies aren't going to be over that 300,000, you could choose to voluntarily register, because that would allow you to claim the input GST. But that would be a sort of individual business decision based on your circumstances. But to be clear, an unregistered business is not required to charge GST to their customers, but also can't reclaim it on their costs. So if you're a business that makes standard rated supplies, then each quarter you would need to remit the difference between the GST you've collected from your customers and those you've incurred on your costs. So this would generally ensure that we collect 5% on the end price of the goods. At the other end, if you're a business that makes zero rated supplies, then the rate of GST you charge to your customers, it's still considered a rate, so it's 0%. So you're not actually collecting any GST from your customers, but you're still able to reclaim any GST you incur on your business costs. So the effect on price should be neutral. If you're a business that makes exempt supplies, then you don't charge GST, but you also can't reclaim GST on your costs. So the impact on prices there is going to be somewhere between 0 and 5%, depending on the nature of the business. So this slide shows what has been proposed as zero rated and what's been proposed as exempt supplies. Now, the proposal is that this is a broad-based GST, so there are relatively limited at the moment items that are proposed to be zero rated or exempt. So exempt are things like medical care, childcare, also things like domestic financial services and insurance. Particularly with those, it can be very difficult to calculate what the GST is charged on. So typically you'd see them as exempt in other sort of GST systems. And then treated as zero rated are things where, due to their cross-border nature, it can be difficult to determine where the GST liability would arise. So, for example, cross-border travel, and it's also proposed that would extend to travel within the islands in the bailiwick. I think it's important to note that things like salaries and wages are outside of the scope of GST. And also, just to confirm, the position for charities is intended to mirror that in Jersey. So charitable supplies are exempt, charities are treated as exempt, but they can reclaim any input GST they incur. So charities are effectively treated as zero rated, but they don't have to submit the quarterly returns. So this next slide just gives you a flavour of the likely information that would be required on any GST return. The intention is to keep it relatively straightforward with minimal boxes to complete. And the image on the right, which probably isn't legible, is a screen grab of the Jersey GST return, but pretty much it would just ask for details of sales and the input GST collected on those sales, purchases, and the sort of output GST that the business is seeking to reclaim with the value of imports. And then there will be a calculated figure of whether the business needs to pay across the GST to your government, or if you're a zero rated business, then you're probably going to be in a refund position, and each quarter you'll be submitting a refund position. So I appreciate that was a bit of a whistle-stop tour, but I will hand over to Liz now. Okay.
So the International Services Entity Scheme, which I mentioned previously, is quite an important element of the GST. So as you would have seen on the previous slide about the treatment of various goods and services, the export of services is a 0 rated service. So that means that all other things being equal, financial services which are being provided to clients outside of Guernsey would be 0 rated. Now, one of the problems they identified in Jersey when they were introducing GST there was that first of all, that doesn't generate any net revenue from the financial services sector, but it also involves quite a lot of administration for the financial services sector in order to reclaim their input GST in order to achieve that 0 rating. The International Services Entity Scheme is a way to get around that and both reduce the administrative burden on the international financial services sector and to generate some net revenue from the sector for the government, so they are paying their share as part of the design of the GST. So essentially what this means is that financial services businesses can register for this scheme. They are issued with an end user certificate, which they can then provide to their primary suppliers. So things like their accountants and their lawyers, which means that they don't get charged GST in the first place and therefore don't have to go through the process of filling in quarterly returns in order to reclaim that GST. There is an expectation that they are going to incur some GST on an incidental basis, because, for example, you know, the Cafe down the road, if they provide them with sandwiches for lunch, is not going to be able to remove GST for just for a one-off sale. So there will be a facility for those entities to reclaim any incidental GST that they might incur on a kind of light touch basis. This is set up with a fixed fee structure, which is designed so that what I might call the lead entity, so the managing entity, either the bank or the fund administrator or the kind of primary fiduciary license, will pay a kind of lead fee for access to the scheme, and then any managed entities that sit underneath that will have a smaller fee attached to that. What they discovered in Jersey is that this generated much more revenue than they were initially expecting. Our estimates are currently that a scheme of this nature might deliver somewhere between 10 and 12 million pounds towards the overall revenue contribution of the systems. So that is where we are. Online retail, this is one that comes up quite a lot. And again, we are learning lessons from Jersey that they have moved first on this. So what we are proposing is that from the outset, any retailer external to Guernsey who is selling goods directly to customers of a value of more than £300,000 will have to register for GST as if they were a local business, and they will have to charge GST at source. So all the big online retailers will have to sign up for GST when you go along to those sites and purchase your goods. Then the GST will be applied at the checkout. And that way, the GST is collected at source, they remit it directly to the government, and there is far less friction at the border for collecting GST of imported goods. Having done some work with the customs systems, we currently believe that more than 90% of goods being delivered directly to customers would be captured by a scheme of that nature. There are some very obvious online retailers who I'm sure quite a lot of us use more often than we would like to confess to, and they cover an enormous proportion of the goods delivered directly to households in Guernsey, particularly at the lower value. So what that means is that actually there's only really about 10% of consignments that are being received across the border where there will need to be some kind of intervention from the customs agent in order to collect the GST. You may have heard at various times a discussion about something called de minimis. A de minimis is an administrative provision used by governments and customs agents in order to make sure that the collection of these kind of taxes at the border remains cost effective. So in effect, it provides a mechanism where you can say we're not going to go out and collect tax. If it costs us more to collect that tax, then we're actually receiving in revenues. That hasn't been defined at what level that will be set at the moment. The UK, I think, currently have it set at about £135. Jersey currently have theirs set lower. So there's still a process for us to go through to determine where that will be. It's likely that there will be some transition attached to that. For businesses, if you are importing goods that are coming across the border, if you are a business that is registered for GST, all that will be captured within your quarterly returns and you won't need to do anything different. It'll come through the border without any additional friction, be delivered. You will declare those imports as part of your quarterly return, as you saw earlier, and there won't be anything more complicated than that. For those businesses who aren't registered for GST but who are still importing goods, you should be able to register as an approved trader. What that will mean is that it'll allow the customs agents to essentially bill you for your GST on imported goods on account without detaining your goods again. So that will mean that you will get your goods without delay and you will be billed on a monthly or quarterly basis, however that plays out, if this is something that ends up becoming a reality. The third group, if you are a business and you don't register for either of the two options, either the full GST registration or the approved trader scheme, you will need to pay any GST on your goods before they are delivered, and there might be some frictional delay attached to that. The idea of the approved trader scheme is in fact to try and limit the occasions where people might find that they've had their goods detained at the border. So you know, there almost certainly will be an incentive and encouragement for people to register as an approved trader if they're not registered for GST in full, if they are regularly receiving imported goods, just to make that whole process a bit smoother for you. So the floor's rock.
Okay, yeah. So yeah, now we'll go to questions very soon, but just to say that, you know, we since probably September last year have been engaging with industry, some of that to, you know, help inform as many people as possible about what is involved in the package, but a lot of it has been fact finding from businesses and trying to understand what those businesses do, and then say, okay, well, this particular package, what are the things for each sector that we need to consider? And some of the things there that Liz and Nikki pointed to, where there's still some decisions to be made, like for example the de minimis threshold. You know, there's a lot of, or whether or not the decision the states were making this week about food. You know, we've done a lot of engagement with businesses to try and understand the perspectives of all the different sectors and what the implications would be for them. So that fact-finding process is still ongoing. We hold kind of technical engagement sessions, is what we call them, with different representative industry groups for all the different sectors. We've also set up an industry change panel, which then has representatives from a whole bunch of different industry groups or individuals who work in a very particular area to have a group that we keep up to date with and meet regularly with, and is constantly feeding into whatever the latest stuff that we're looking at is. Alice and Di, who are both on the call, who are both members of that industry change panel, have been super helpful in making sure that we know that we're looking at the right sorts of questions and we're trying to work out the right sorts of problems as we move through this. People want to find out more about the tax reform process, the two work streams that we talked about at the beginning of this. They can go online, go to gov.gg/tax reform. From there, it leads you down two ways. So if you wanted to look more at what's happening with this GST-plus package, there's a button called tax package, and you can look at that. And if you want to know more about the tax review that's looking at those corporate tax options, there's another button and it takes you that way. And there is a bit of a new announcement because the Policy and Resources Committee is just put together a tax calculator, which now lives on that site. So if you go onto that gov.gg/tax reform, click through to tax package, you'll find a tax calculator, which allows people to put in their own details and then see how would this package, what would that mean in terms of essentially whether you're better or worse off as a result of the changes that are included in this package, if the states decided it eventually wanted to move forward with this package. So that's a new feature that's just available from today if people want to take a look. And the other thing, people can obviously come to us and ask questions. So at the moment there is an email, gst+@gov.gg, and we're very happy to receive questions, technical questions. We'll come back and answer those, or even if you just want to flag things to us and make, send in a comment. If there's something you think we haven't thought about, very happy to hear about that too. You can use the QR code as well, which will lead you to a contact form, which will do the same sort of thing, and you can get those comments and questions to us. And I think that's it. So I'll stop sharing my screen at this point. And I don't know how much time we've left. We're happy to carry on a little bit longer, obviously, if that's possible, Alice, but obviously happy to take questions.
Absolutely. Thank you very much, team, for that very comprehensive overview of the GST plus package. We haven't had any questions come through into the Q&A, but I have got questions that we have been previously asked that I think we probably should cover off. So the first one I've got, and I don't know whether Di, you might want to step in on this one, is I don't have to register my business as my turnover is under 300k, but is it in my interest to register?
I can, like, I just think that certainly at electioneering, my concern was some people standing for deputy were just saying, don't worry, you can just opt out. That might actually be the worst thing to do. That might cost your business more. So that should be something to discuss. We as Chamber will happily run more sessions, do that. We can look with individual businesses. I'm an accountant, talk to your own accountant. But you might be a business that offers services and incurs very few costs, and you might be best to opt out as a small freelancer, or you might incur quite a lot of GST, even though your threshold is under 300k, and you might be best to register. Do not be put off by the admin, because I think that, doesn't need to be too much of a barrier, can be made easier.
And that was going to be my next question, actually. So for businesses that will need to invest in new systems and training, what practical support or transitional assistance is there going to be to support businesses with the implementation of GST+? Who wants to go on that one, Di or the team?
Maybe those guys start.
Yes, we should try to answer that. It's not an easy answer though. Do you want to go for it, Nikki?
Yeah, I can start us off on that one. So I think it was recognised that the introduction of this package of measures, there was quite a lot for business within it. So included in the original policy letter that went in 2022, which is what the resolutions that we're working to now are based on. It did include a sum of approximately 1 million to provide support to businesses for the introduction of this package. So I guess there's a number of ways that support could be offered, and it's certainly something we intend to discuss with the industry change panel, whether it's organising training sessions, whether it's grants for purchasing software or what it might be. We're keen to speak to business, understand what support they need, so that we can then go take that away and work out what we can put on offer. But I don't know, Di, if you want to
yes, all I would just add to that is, like, that's my day job, is cloud accounting and getting people onto the cloud. And for us, we see that as something quite easy with huge advantages. So if this was the trigger that made a business get a new accounting system in place, like a good everyday cloud accounting system, there'd be no end of other benefits, and that doesn't have to be overly costly. And then if there's support for that as well, don't be fearful of that. And I think if you don't have such a system in place, you would see many other advantages that would help you understand your numbers, grow your business, etc., make decisions, as well as enable GST reporting. I think we'll, as Chamber, we'll look at running some other sessions that maybe give some demos of cloud accounting, just so if this happens, people have got a little bit more information ready to know that's easy. And then if GST does happen, we can evolve that into bigger workshops on how to actually do the GST admin and reporting.
Super, thank you. A question that will probably be for you, I think, Liz. What modelling has been done on how GST might affect consumer behaviour and demand, particularly in sectors like retail, hospitality and leisure?
Yeah, so there was right back at the beginning of this process, which I appreciate was some time ago now, a piece of work done by one of the big four accountancy firms looking at the economic impact of these kind of changes. It did identify that there were particular sectors who were maybe more vulnerable than others to changes in demand and changes into consumption, particularly around retail. I think it's also worth noting that if you increase income taxes, you also see the same kind of impacts on retailers in particular. So it's not as if this is something that's isolated solely to consumption taxes. We know from the experience in Jersey and having done quite a lot of engagement with various industry groups that they're particularly at the threshold of introduction, you tend to see people making decisions about when they make larger purchases in particular. So we would expect to see some of those kind of behavioural impacts around any transition from a world without a GST and a world with GST. It is worth noting that because the package as it's presented includes both the GST and an increase in people's disposable income, that they have opposite impacts on people's consumption behaviour. So having more money in your pocket, particularly for people at the lower end of the income spectrum, would tend to mean that people will be spending more in businesses and with retailers. The increase in price as a result of the GST will tend to suppress consumption. So there will be pressures in both directions. That helps.
Thank you. Right. A question on social security rates. I'm interested in understanding why non-employed social security rates are lower. It can often be higher earners who are in this cohort.
I'll take that one. Okay, so this is part of this is because of the complexity of the way our current system operates, and some of the perverse behavioural incentives that exist in our current system. So leaving pensioners aside for the moment, if you are employed or self-employed, and you fit into either what we call class 1 or class 2 contributions, that definition means that any unearned income that you have remains out of scope. And what that does is creates an incentive for people to just meet the very minimum threshold for being classified as employed or self-employed if they also have quite a lot of unearned income. So one of the things that we wanted to do in the design of this package was to try and fix some of those perverse incentives. The current rate of contributions charged on unearned income is currently much higher than the amount that you would be paying on earned income. So again, you get this complexity, and one of the discussions that we had was that actually a single rate across the board that you as an individual would pay on either your earned income or your unearned income would be much easier to manage, much simpler, much more consistent, and much easier for people to understand. What that does mean is that for the small, as there's really quite a small group of people who have only unearned income and are classified as non-employed, and passing the income threshold at which you start paying on a full threshold, because if your income's low, you're not required to pay. It does mean that the rate for those people goes down in order that it's consistent across the board.
Thank you. All right, we have got 5 minutes if anyone else wants to put a question in the comment box. But if, before I go to another question on my list, is there anything that Di or the team at Frost & House want to add in? Is there anything that you don't feel that you've covered or you've forgotten you want to mention now?
I mean, the only thing I would say is that so we did that presentation in about 45 minutes, but even that's a bit of a whistle-stop tour through the whole thing.
Yeah.
And it is quite complex. This would be, if the state decided to do it, right? It's a big change and there's quite a few elements to it. So, it isn't simple. And so when we're having some of the technical sessions with industry groups, those can be 2+ hours long as we kind of dig into little bits of detail. We're very happy to do that. If people want to come back to us and say, look, nobody's come to my business sector yet. You're probably on our list already, but we're very happy to start scheduling stuff in with you. Or if you just have questions as an individual business, again, very happy to receive those or come and see you or talk to you. So, if that 45-minute presentation hasn't made it crystal clear, that's not a problem. We're very happy to kind of carry this on. I did see in the chat somebody asked about the tax package. Oh, you've given the tax package link. Thank you, Alice. It's gov.gg/tax package. Will take you straight to that tax calculator if anybody did want to have a look at that too. I don't know if there's any more to say other than to also just stress that really, the role that Nikki, Liz and I are playing in all this is just to kind of concentrate on how would this package work and try and be ready for a smooth implementation process if that's what the state's decided to do. But it's ultimately, a state's decision. The community, businesses, individuals will have their own views on all the different tax things that are being discussed at the moment, and will want to lobby their politicians, and rightly so. And so that's kind of, we're stepping a little bit away from that to just in the background say, okay, but if it does go ahead, do we know how it would work? And that's really what this whole work stream is about.
And I guess I'll add to that and then as a bit of a wrap up. So as a reminder, the corporate tax consultation closes this week. So if you haven't responded to that, do. The debate this week is to politicians just on whether or not they are applying GST to food or not. And then should all things go to plan and follow the process that has been originally set out, government will look at their overall package in May. So if you have any feedback on the overall package, that would be the time to feed that into your deputy or even us chambers. If you've got any questions up into the run up, please do get in touch. We're happy to help. And if are there any follow-up sessions that you want to this, looking at particular aspects of any of the two work streams, please do shout out. We are happy to help. We appreciate that it is a lot to follow and keep up with.
Yeah, and I was going to say the same, Alice, in that, people might have sort of questions forming but not be sure. They're welcome to discuss that further with us, and we can then take that to the meetings that we go to as well. And we have some aspects that we're kind of thinking that we want to make representation on, but after the food debate we want to represent our members. So if there's other topics that people want to discuss, like some of the detail we're getting into is what is going to be zero rated and not, and there's some potential anomalies or areas open for discussion. As an example, commercial rent is potentially going to be standard rated, and personal rent, that's probably not the right word, is going to be zero rated. Those sorts of things, and the impact of that. I have concerns about the extra social that will be charged to businesses. That's something I want to understand more and consider if that has to happen, because that's absolutely a cost that will hit SMEs. You can't just register to do the admin to avoid it. It will go up, and it's kind of
significant.
Everything. Yeah.
Okay, well, on that basis, we're bang on past, so I'm going to end it here. You will all get the recording, and I will put people's contact details in to contact the tax team. But thank you ever so much to the panel and everybody for joining.
Thank you very
Thanks,
much, Alice.
guys.
Thank you,
Thanks,
Ty.
guys.
Thanks, everybody.